The question is what are financial statements? This is also a question. What are financial statements? So financial statements are structured representation of financial position and financial performance of an entity. Structured representation means it is arranged in a standard format, structured format, in an understandable format, in a logical format. Okay, and what does financial statement represent? Two important things. One, financial position. So guess what statement is called financial position? What we call balance sheet or statement of financial position, where you show assets and liabilities and financial performance of the entity. Which statement shows the financial performance of the entity? Profit and loss account and other comprehensive income and statement of changes in equity. Okay, this shows financial performance of the entity. Why do we need financial statement? To enable the users to make economic decisions about the entity. To meet this objective, a complete set of financial statement is to be prepared by the entity. So that is about financial statement. Now this can be a question for you. What is included in a complete set of financial statement? So complete set of financial statement under IFRS would include statement of financial position, which in this notes and in our entire syllabus we will call it SOFP, or while talking we can call it balance sheet also, but while writing we will write SOFP in this subject. A statement of profit or loss, which we will call SOPL, and other comprehensive income for the period. A statement of change in equity for the period. A statement of cash flow. Notes comprising of a summary of significant accounting policy and other explanatory information. And some companies may be required, not all, some companies may be required to give a third statement of financial position. A third statement of financial position at the beginning of the earliest comparative period. So in addition to the two statements, for example, suppose my year ending date is 31st March 2020. So this balance sheet I am going to give as at. I am also going to give a comparative balance sheet 31st March 2019. But if either of these three conditions are fulfilled, then I am also required to give one more SOFP as at the beginning of the earliest period presented. So which is the earliest period presented here? 31st March 2019. The beginning of this year is 1418. But when are you supposed to give this third balance sheet or third SOFP? When an entity applies an accounting policy retrospectively. Again, this can be a 2-mark question for the student. When is a third SOFP required? So when the entity changes the accounting policy retrospectively or makes a retrospective restatement of items in its financial statement. Retrospective restatement, for example, any prior period errors which might have to be rectified. Prior period errors which might have to be rectified from retrospective effect, or when it reclassifies items in its financial statement. Reclassification from one classification to other classification. Like fair value through P&L account item can be reclassified as, let us say, amortized cost or FVTOCI instrument. Okay. So if any reclassification takes place, then it has to be done with retrospective effect, and then we will be required to present one extra SOFP at the beginning of the earliest period presented, like this example I had written. Now, very important tick mark, what are the purposes of financial statement? Some paragraphs I am not reading because they will come in the course of our lecture in the next few minutes. Okay, so don't worry. Purpose of financial statement is to provide financial position information, financial performance information, and the information about the cash flow. Which statement gives you financial position information? SOFP, statement of financial position. Which statement gives you financial performance information? 2. SOPL, statement of profit and loss and statement of changes in equity. This also includes OCI and cash flows, statement of cash flow. This I have not written here, I should have written statement of cash flow. Right, statement of cash flow. Okay. Financial statements are a structured representation of financial position and financial performance of the entity. So this line is repeated in the notes. The objective of the financial statement is to provide information about financial position, financial performance and cash flow of the entity, which will be useful for a wide range of users in making the economic decisions. Okay, and how do investors get to know about financial position, financial performance? The following details are provided in the financial statement. Which are the details given in financial statement? Assets and liabilities. So here he gets to know what is the financial position, how much assets the company own, what are the liabilities it owes, and if you are a banker, based on this financial position of assets and liabilities, you take your decision to grant loan. Then what is equity? What is the owner's capital invested? Then you get to learn income and expense through the statement of profit and loss. You get to learn about contribution by and distribution to owners in their capacity as owners. This transaction with owners will be shown in which statement? SOCIE. And then there is a very important statement which they present is called cash flow statement. The purpose of cash flow statement is to tell you the ability of the firm to generate cash and utilization of cash. Is the company able to generate cash flow from its operation? Where it is investing the cash and how it is financing its cash requirement. So cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, they are presented, and this helps us to make a better understanding of the financial statement. The information along with other information in the notes assist the users of financial statement in predicting the entity's future cash flows and in particular their timing and certainty. Why do we give such detailed information? Not only he understands what you have achieved in the past, he can use it for making projections about future. Like in offices, when we handle a client, he wants a loan from the bank. Not only we prepare the past statement, we also prepare a future balance sheet, future P&L account. Why? So that the bank will understand what are its possible future financial position and performance. But the base for doing that is the past financial statement. General features of a financial statement. So as per IAS 1, following are the features which a financial statement must have. First, this is a list of what we are going to do in the next few minutes. Fair presentation and compliance with IFRS. This IAS or all IFRSs use the term fair presentation instead of true and fair. Is it right? So this is fair presentation, whereas in Ind AS they use the term true and fair. So this difference will keep in mind. and compliance with IFRS. Then we'll discuss going concern, accrual basis of accounting, materiality and aggregation, offsetting, frequency of reporting, comparative information, consistency of presentation, structure and content. Okay, so these are the basic elements of financial statement. First, we will discuss about the presentation and compliance with IFRS. Tick mark presentation and compliance with IFRS. So what are the factors we have to keep in mind here? Financial statement shall present fairly financial position, financial performance and cash flow of the entity. So what is expected from the management? They will give a fair presentation of. That means what it is there, they must present it. It should not be biased. Is it right? It should not be subject to error prone. It should be reliable. That is called fair presentation. What are the items for which fair presentation we expect from the management? Same three items: financial position, financial performance and cash flow. Fair presentation requires the faithful representation of the effect of transaction, other events and conditions. You are an outsider. What you will get to see about a company? Financial statement. So you trust that it is truly presented. So it is the duty of the management to make a faithful representation of the effect of transaction according to the various standards that we are going to cover, according to the definition of asset, liability, income and expense that is given in the framework of the IFRS. Is it right? An entity's financial statement comply with IFRS standards must make an explicit and unreserved statement of such compliance in the notes. Very important. If your financial statements are complying with IFRS, all IFRS, then only you will make the statement. And what is the statement you are going to make? That financial statements are IFRS compliant. If there is any deviation, then you can't say that our financial statements are IFRS compliant. An entity must not describe, I have written that line also. An entity must not describe financial statement as complying with IFRS standards unless they comply with all the requirements of the standard. Underline. Unless they comply all the requirements of the standard, you can't say that financial statements are IFRS compliant. The application of IFRS standard with additional disclosures when necessary is presumed to result in financial statements that have achieved a fair presentation. These IFRS standards are so detailed, so comprehensive, that if you apply them properly and if you provide all the disclosures that are mentioned there, then automatically what will happen? Your financial statement will achieve to a certain degree fair presentation. Okay. Inappropriate accounting policies cannot be rectified either by disclosure of accounting policy used or by notes or by explanatory statement. What does that mean? You can't justify a wrong accounting treatment merely by disclosure in the notes. Okay. Suppose LIFO method of inventory valuation is not allowed and you have valued your inventory using LIFO method, and you've written in the notes also honestly that inventories have been valued using LIFO method. Still your financial statements are not compliant with IFRS. So then you will not write at the end of your notes that all the financial statements are IFRS compliant, even though you have disclosed that you have followed a wrong accounting policy. Can we depart from the prescription laid down in the standard? This is very rare, but in some situation it is allowed and subject to certain disclosures that are given in IAS 1. Okay. It is written in extremely rare circumstances. In extremely rare means this should not happen on a regular basis. In extremely rare circumstances, the entity may find it appropriate to make a departure from complying with the prescriptions laid down in the standards. This may happen in cases where the management concludes that complying with a requirement in IFRS would be misleading. If you comply, it will be misleading. If you do not comply, then it would not be a misleading statement, in which case the entity shall depart from the requirement in such manner as described below. Like example, I am repeating again, fair valuation of certain derivative product. Now it is not traded on any exchange, so getting its fair value may be very difficult and there is no expertise available to get the fair valuation done. Is it right? So in that case, might be you can just value it at whatever the cost that you might have incurred. Because doing the fair valuation for which you have no definite source of information is going to be misleading. Where the management is of the opinion that presentation of true and fair view of financial statement is achieved only with a deviation from a particular requirement, and such deviation is required or not prohibited by the regulatory framework. Now this line I need to explain. There are two types of situation. One, when regulatory framework does not prohibit deviation. Law of the country does not prohibit deviation. Then you can deviate, subject to whatever disclosures I have written in situation 1 below, left side of the table. But if the regulatory regulations, law of the land, do not allow deviation, will you still deviate and make a disclosure? The answer is no. Then your financial statement will not deviate. However, in the notes you will mention that we have followed the respective standard because we were prohibited by the law from deviating. So now we will see the two tables for a better understanding. Situation 1 deals with when the law of the land does not prohibit the deviation, and situation 2 deals with when the regulatory framework prohibits a departure. Agreed? Okay. So what will you do? There are following points you will keep in mind. If you are deviating from the standard and the law does not prohibit the deviation, the entity can make the deviation allowed from the requirement of a particular standard. But then you have to give lot of disclosure. Disclose that the financial statement, make a small correction here. Disclose that the financial statement present fairly financial position, present fairly the financial position, financial performance and the cash flow of the entity. Okay, so you have to make a specific disclosure that financial statement, in spite of deviation, give a fair presentation of same three items: financial position, performance and cash flow. Disclose that the requirement under the standards have been complied with except for that particular requirement. So your disclosure requirement will become more extensive now. Give the disclosure that financial statements have been IFRS compliant subject to the following deviation, and give a description of the title of the standard and the accounting treatment required under the standard, what you are supposed to do under the standard and what you have actually done, and the nature of departure, what you should have done under the standard, what you have actually done under the standard, and why you have deviated. Reasons justifying the compliance with the requirement would be misleading. So in fact you have to give a lot of explanation to your investor that we have deviated, why we have deviated, okay, and financial effect of this departure for each period presented. If you are willing to do so much compliance, then you can deviate, subject to regulatory framework does not prohibit deviation. But if the law of the country says that companies have to follow IFRS without any single deviation, then you can't deviate. Now, there is a situation too where regulatory framework prohibits departure. Then what the entity will do, comply with the relevant IFRS for the transaction or event in the question. That means do not deviate. Do not deviate while preparing statement of financial position, statement of profit and loss, statement of cash flow. You will not deviate, and give a description of the title of the standard and the nature of the requirement therein. Only what you will do in the notes, you have to give the explanation that we should have deviated, but because of the regulatory requirement we have not deviated. The nature and extent of adjustment required to each item in the financial statement in order to achieve fair presentation. Those such adjustments should not be made. Underline. You have to only write in the notes, in order to achieve fair presentation we should have deviated, but you should also write we have not deviated. Why? Because of the regulatory prohibition. At least the investors, you have passed on the information that we should have deviated by so much, but we have not. So what the investor will do, while evaluating the performance, he will read this note also, keep this note in mind, and then do whatever evaluation he wants to do. So he is aware that there was a deviation required. So what was my first general feature of financial statement? Fair presentation and compliance with IFRS. Second is going concern assumption. This is the very simple one. From basics of accounting we have been learning. An entity is required to make an assessment of its ability to continue as a going concern and prepare the financial statement on a going concern basis. So what the entities will have to do? They will have to check whether they are a going concern. And then for your homework I have given a going concern checklist on the paragraph below, and you have to read that as homework. Following things they will check. Is it right? Going concern checklist. And if the entity find that they are not going concern, then they will not prepare the financial statement on a going concern basis. Is it right? When the entity is no longer a going concern, when the entity intends to liquidate the entity or cease the trading, or has no realistic alternative but to do so. So in simple words, the entity will wind up its operation in the near future, and that near future would be 12 months period. Is it right? This disclosure is important because investors should know that this company where I am putting my money may not remain a going concern after a 12 months period. Now, if going concern assumption is not valid, it is possible that some companies may find that it is not possible to continue beyond 12 months. Then will you still prepare your financial statement on a going concern basis? No. You will change the basis of preparation of financial statement. And in that case, whichever basis you will follow for preparing the financial statement, you will give appropriate disclosures. What will be covered in your disclosure? In case if you are deviating from your normal standard now, because you are not a going concern anymore, you have to give the basis on which financial statements are prepared. For example, you may be valuing your property, plant, equipment on cost basis under IAS 16. But now your company is not a going concern, you might value it at the basis of market price. So you are not preparing as per your regular IFRS now disclose that assets are valued at their current market price, and then you have to also disclose why the entity is not regarded as a going concern. This is simple. I am not going into too much of detail. You have been learning in your accounts batches since ages. The going concern assessment is based on assessment information of at least 12 months from the end of the financial period. So what the company has to see whether at least for 12 months we are going to survive or continue with your business or not. Next is accrual basis. Third basic general feature of financial statement is accrual. You will find I have not written much on this, and the reason is that you know everything about it. Accrual basis means income is recognized when it is earned. Expenditure is recognized when it is incurred. That means income is recognized when we have the right to receive the consideration. An expenditure is recognized when we have an obligation to pay. Okay, irrespective of the receipt or payment. But one statement is prepared on cash basis. Which statement is prepared on cash basis? Cash flow statement. It is based on actual inflow and outflow of cash. So even though the standard says follow accrual basis of accounting, it is not applicable for cash flow statement. Okay. The next feature is materiality and aggregation. Discussed in the definition part also. Where a line item is not in itself individually material, then it can be aggregated with other items. Okay. But this is again a subjective matter. Like for example, suppose you incur expenditure on books, and you incur expenditure on notebooks, and you incur expenditure on pens and pencils. Do we need to separate them in the financial statement, or can we put them under some common heading? Printing and stationery. Is it right? Printing and stationery. Because see, giving too much of information which is not material in decision making is not required. So you can club them. That is called aggregation. Then it can be aggregated with other items like depreciation and amortization. If the thing amortization amount is not material, depreciation amount is material, then maybe you can club amortization with depreciation also. Okay. If possible, you can give them separately also. Nobody stops you from writing depreciation separately and amortization separately. Okay. Then each material class of similar item should be presented separately in the financial statement. Each material class of similar item should be presented separately in the financial statement. Item of dissimilar nature or function should also be presented separately. So you can't add employee benefit expense with financial expense and write as one line item. They are very dissimilar. Now next feature is offsetting, on which I am going to take one question also, two questions also. Be ready for the question now. What do you mean by offsetting? Showing a net amount instead of two figures. Like for example, let us say in balance sheet we pay advance tax 2 lakh and we have a provision for tax 3 lakh. So there are two ways you can present in the financial statement. One is on the asset side you can write advance tax, on the liability side you can write provision for tax. The other way is you can write provision for tax net of advance tax 1 lakh. So can we do the netting off in the financial statement? The answer is yes, if it is required or permitted by an IFRS. It is not your choice. It is the standard which permits you. In this example, the answer is yes. But suppose if I say I have a bank overdraft with State Bank of India and I have a fixed deposit, my investment in fixed deposit with say Citibank, can I write net amount in the balance sheet? Bank overdraft is a liability towards a bank. Fixed deposit is an asset which we have with a bank. Can I write net amount? No. You can't do the netting of here, even though both are related to a bank item. Okay. So this way. So you can offset if it is permitted or required by an IFRS, which we will discuss in different standards. Okay. Few examples of netting is written here or offsetting is written here. When you sell say an item of asset, property, plant, equipment, you have sale expenditure, you have sales value, sold this mobile phone for say 30,000 and you incur 2,000 rupees brokerage. So how will you present this information in statement of profit and loss? Will you write sale value and cost and brokerage all separately, or you can just net off and a single amount of profit or loss will be written? Okay, answer is we can set off, and only the net amount is shown when we sell an item of property, plant and equipment. Is it right? So its cost, its sale value and whatever expenditure we have incurred, all of this will be brought together and we'll see the net gain or loss, and that is sold. But in case if you sell normal inventory and if you purchase that inventory, will you write only net amount in the statement of profit? No. There we write revenue from operation separately and cost of goods sold separately. Is it right? That is not set off. Sometime we can set off the foreign exchange gain and losses. So in the statement of profit and loss, all foreign exchange gains and losses are brought together and a single item, either gain or loss, is presented. Then gain or loss arising on financial instrument held for trading. However, an entity presents such gains and losses separately if they are material. Measuring assets net of valuation allowance such as obsolescence allowance on inventory is not an offsetting. Now what is this item? Suppose you have an inventory 10 lakh and you have made a valuation allowance. Valuation allowance means you can say here impairment loss provision on inventory. That is not called offsetting. That is a presentation requirement. Let us put a simple example. Instead of inventory, you have trade receivable 10 lakh less allowance for bad debts, less allowance for bad debts 20,000. So this is 9 lakh 80,000. Now this is not an offset. This is not an offset. This is a presentation of the respective asset in the financial statement. Offset means when we are setting off an asset against a liability, an income against an expense. Similarly, when you write say property, plant, equipment less depreciation, is it an offset or is it just a presentation requirement? Presentation requirement. Are you ready to solve a question? Yes, solve without reading the answer. X Limited sold an item of PPE, selling price 100, cost 85, accumulated depreciation 15. Selling expense 2. Will you write these 4 items in the statement of P&L account, or just the net gain you will write? So what is the net gain? Calculate the net gain. Cost is 85 and selling price is 100. They have given some figure. 30 million is the net gain, gross gain. Gross gain, how did you get the gross gain? 85 million minus 15 depreciation. So book value is 70. 100 minus 70, gross gain is 30 and 2 is selling expense. Will you present 2 and 30 separately, or you can do the setting off and only present 28? So in this case the answer is the gain on sale of PPE rupees 30 million can be presented net of selling expense of rupees 2 million. So 28 million gain on sale we can present. Okay, try one more, only on the screen. Do not read the answer. During 2019-20, X Limited created a provision for warranty claim of rupees 5 million under IFRS 37. Make it IAS 37. IAS 37. Under IAS 37, which is called provisions, contingent liability and contingent asset. Should the entity present warranty expense of rupees 5 million as an item of expense and the related reimbursement as a separate item of income? There are 2 accounts that you have opened. One is provision for warranty, 5 million. Reimbursement 2. Is it right? So should we present net amount 3, or should we present this as an expense and this as an income? Net amount? Yes. When we will discuss IAS 37, provisions, contingent liabilities and contingent assets, so that time you will read that you can net off the provision against the reimbursement that is received. Okay. So it shall present provision net of reimbursement as per IAS 37. So this is my 5th item. What is the 6th basic features of financial statement? Frequency of reporting. As per this standard, the frequency of reporting is annual, at least annual, once in a year. Okay, but sometime there can be a gap of more than 12 months. If the time gap between 2 periods is shorter or longer than the annual period, then the entity shall disclose the reason for adopting such a longer or a shorter period and mention the fact that the amounts are not entirely comparable. Now, what is the example when your company may have to follow a longer or a shorter period? Year ending date of an entity earlier was 31st December. Okay. Revised year ending date. Revised year ending date, what they have done? They made it 31st March. Now let us say this is 31st March 2020. Now 31st March 2021. So either they may prepare this financial statement, so then it will become only a 3-month financial statement. Okay, it is less than 12 months. Some companies, what they will do, they will say 3 months is very short. So now I am directly going to prepare the financial statement on 31st March 2022. So this will cover now how many months? 15 months. Or this may cover say 3 months. In this case, it is possible that your financial statement may be more than or less than 12 months. So you can do that. But then you have to disclose why you have done it. One reason can be the law of the country may have changed. Second, your company might have become a subsidiary company of another entity, and that another entity, which is now your parent company, may require you to follow a different year ending date. Is it right? So in that case, you have to disclose the reason. And second, for comparison purpose, now what you will do? Suppose this is your current year, your comparison will be 31st March 2020. Sorry, 31st December 2020. This is the last time when you prepared the financial statement. Now this and this cannot be compared, especially the statement of profit and loss part, because this is based on a 12 months profit. This is based on a 15 months profit. So you have to give a disclosure that the amounts are not entirely comparable. Otherwise, investor will think all of a sudden the profit has jumped by 25%. Arey, this is a profit of 15 months. This is a profit of 15 months. And what about the comparative? The financial information shall be for a minimum of 2 periods. One for current period, one for comparative previous period. Comparative information for the prior periods is required to be provided in the notes to account as well. Comparative information. Next point is 7th point, comparative information. 7 feature. Why do we give comparative figures? So that the investor can see what is the performance, growth, progress. Okay. How is the company doing in this year vis-a-vis earlier year? So comparative information is presented in respect of previous period for all the amounts reported in the financial statement of the current period. So it is mandatory. For every figure that you have presented, you have to give comparative information. Then in the next 1 or 2 paragraphs, there is a note on additional balance sheet. Did you remember additional balance sheet? When is additional balance sheet required to be given? When an entity has to do any of the following 3 events or transactions. There is a need to apply an accounting policy retrospectively, or the entity is required to make a retrospective restatement of an item in the financial statement, and an entity reclassifies items in the financial statement. So these 3 terms you again underline. Retrospective application of accounting policy, retrospective restatement of an item, or reclassification of an item in the financial statement. Then in that case, one more balance sheet will be given. What will be the date of that balance sheet? Beginning of the earliest comparative period. Beginning of the earliest comparative period. This paragraph we have covered. Next paragraph talks about change in presentation or classification. Below that, the next paragraph, change in presentation or classification. When there is a change in presentation or classification of item in the financial statement. Now what will be the problem? Current year and previous year data cannot be compared. Then comparative information are also reclassified. Comparative information will also be reclassified, and the nature, amount and the reason of reclassification are disclosed. When reclassification of comparative item is impracticable, reclassification is impracticable. Impracticable word we have seen earlier. In spite of all possible efforts, the entity is unable to give the effect as per the IFRS. Then it is called impracticable. The entity should disclose the reason for not reclassifying the amount possible, and the nature of adjustment that would have been made if the amount had been reclassified. Give the disclosure why you have not reclassified. and what would have happened had you reclassified. Now one more question, don't read the answer, only look at the screen. Everybody, X Limited found a material error in its financial statement for year 2021-22. How should X Limited present its financial statement for the year 24-25? Now we are preparing the financial statement of 24-25. So when we are preparing, we found that there was an error committed in this year. So what you will do? We are going to prepare one more financial statement, SOFP. So 3 SOFP we will prepare now. One as at 31st March 2025. Comparative as on 31st March 24 and as on 1st April 23 also. Is it right? If the error occurred before the earliest period presented, did the error occur before the earlier period presented? Yes. We are presenting the financial statement of 31st March 2025 and 31st March 2024. And this financial year covers 1/4/23 to 31st March 24. Okay. Now, if the error occurs before this date, then only you will do the application, retrospective application. Now, suppose the error was committed in this year 1/4/24 to 31st March 25. Do I need to revise that 1/4/23 figure? No, it won't change. It won't change. Similarly, if the error is committed between these two dates, then also this figure is not required to be revised because it will remain the same. But in this problem, the error was committed in 21-22 before this year. So you have to give the effect of the rectification, not in the current year, but that year. So go to that year financial statement 21-22. Give the effect of that error, and based on the rectification, your opening balance of financial position will change. That you will bring forward on 1/4/23. That again you will adjust in 31st March 24 and again 31st March 25. So now in fact this paragraph will make the company rethink before they make any error. Sometimes the error is made purposefully also. So if you make such error or omission, there is a punishment. You have to do the retrospective adjustment and give one more financial position statement. Next feature of financial statement is consistency. What is consistency? Same presentation should be followed. Okay. Same classification should be followed. An entity is required to retain the same presentation and same classification to ensure consistency of presentation. If you change the presentation and classification every year, how do I compare the current year with previous year? Financial statement will become less reliable. Investor won't trust your financial statement. So this is important. But of course you can change it in following 3 situations. Situation 1, change in the nature of entity's operation. Change in the nature of entity's operation. Suppose earlier you were giving your trucks on hire basis. Okay, rental basis. Now you are selling the truck. Now you are selling the same truck on a regular basis. So the trucks have become your inventory. So of course your classification of truck will change from property, plant, equipment to inventory now. Or the management thinks it would be more appropriate. Or an IFRS requires such change. When changed, we have discussed. Above requirement applies to comparative information also. Now we'll come to structure and content. Financial statement should be clearly identified and distinguished from other information that are presented in the same published document, for example, annual report. Now, I hope you have seen the annual report of a company. Properly printed notes, have you seen? Never. You will find there, after the director's report, management discussion and analysis, auditor's report, it is very clearly mentioned: statement of financial position, statement of profit and loss of this company for this period, and whether it is standalone or whether it is consolidated. That is the meaning of this line. Whenever you are giving the financial statement along with many other statement in a published document like annual report, the financial statement should be distinguished from other documents by writing the heading, year, name of the company, etc. So what are the requirements of the disclosures in the financial statement? Basic disclosures: name of the reporting entity you will write, and change from the end of the preceding reporting period if the name of the entity has changed, possible. Financial statements are whether it is an individual entity or a consolidated entity. So you will find they write like this: stand-alone financial statement, or they write consolidated financial statement. So the moment you read it, you will understand it is either a stand-alone or a consolidated statement. Then you will always write the date, which period it covers. Then you will always write the presentation currency, in which currency you are preparing. If it is prepared in pound and it is not mentioned, how will the investor understand? And the level of rounding off used. Level of rounding off used is simple, whether you have written in thousand or million or billion, whatever. Okay. So that these are must. You have to give these so that the investor can understand better. So now we have discussed the basic features of financial statement. So who will tell me all the 9 once again? First one, fair presentation and requirement of IFRS must be complied with. Second, going concern. Third, materiality and aggregation. That was fourth actually. Third, fourth, accrual basis. Fifth, offsetting. Sixth, frequency of reporting. 7, comparative information. 8, consistency of presentation. And 9, structure and content. These are the basic attributes of a financial statement. And now we'll come to statement of financial position. What are the structure and content of SOFP? Okay. An entity shall present SOFP by classifying assets and liabilities into current and non-current categories. Okay. So normally you will find companies will show their assets and liabilities into two categories. Which two? Current and non-current. We will see the definition soon. Wait for a minute. What is current asset and what is current liability? But in case of IFRS, there is one option: except when presentation in the order of liquidity is more relevant and provides reliable information. That means instead of giving current asset and current liability, non-current asset, non-current liability format, you can present in the order of liquidity. If it is in the order of liquidity, then you will start with the most liquid asset, say cash in hand, cash at bank, say bank FD, like this, and go towards the end where the item is least liquid. For example, let's say intangible asset. Okay. Practically, I have not come across any entity following this liquidity presenting. Very rarely. Normally, banks and NBFCs or companies in the financial sectors, probably they will follow this classification. So banks and financial institutions can follow this. It may be relevant for them to understand their liquidity. In their cases, liquidity is very important, like financial institutions. But in general, companies do not follow this format. They follow non-current current format, so that it is easy to understand how much is your current asset to support your current liability and how much your non-current liability has financed your non-current asset. Easy to understand. Long-term source should meet your long-term needs, short-term source should meet your short-term need. That is what is the logic of non-current and current item. The standard does not specify the order of presentation or the format. In the standard there is no format, but then over a period of time conventionally we have designed some format to be used, but prescribes only certain minimum line items. Minimum line item means you can disclose even more than that. We are going to read a long list of items to be shown in the SOFP, but remember that list is not exhaustive. How much they can write? So additional line item may also be presented. This line is printed in the note. Additional line item may also be presented if so warranted by the nature or function of the item. You can add some more line item if required. For example, there is an example also printed. Under the head property, plant, equipment, what you can do? You can add two lines, cost model and revaluation model. That means you can write following assets are valued using cost model and following assets are valued using revaluation model, although you will not find that as a specific requirement of this standard, but this is for better presentation, you can do that. What about the presentation of deferred tax? This standard says deferred tax asset or deferred tax liability will never be shown as a part of current item, will be shown only under non-current item. So if it is a DTA, it will shown in non-current asset. TTL, non-current liabilities. Okay. Now your Ind AS 1 says following items should be presented in the statement of financial position. The statement of financial position shall include, inclusive definition means more than that is also welcome, that present the following items. We'll just quickly read them because this is what your IFRS is. Property, plant, equipment, investment property, intangible asset, financial asset, excluding amount shown in E, H and I. Then group of contracts within the scope of IFRS 17 that are assets, disaggregated as required by para 78 of IFRS 17. Investments accounted for using equity method. Biological asset within the scope of IAS 41 called agriculture. Inventory, trade and other receivable, cash and cash equivalent. Total of asset classified as held for sale and asset included in disposal groups classified as held for sale in accordance with IFRS 5, which is called non-current asset held for sale and discontinued operation. Trade and other payable, provisions, financial liabilities, group of contract under IFRS 17. Next, liabilities and asset for current asset as per IAS 12, income tax, deferred tax liability and deferred tax asset as per IAS 12. Liabilities included in disposal group classified as held for sale in accordance with IFRS 5. Non-controlling interest presented within equity and issued capital and reserves attributable to owners of parent. This list is not exhaustive. Anything more than this, more than the IFRS standards, if you want to disclose, you can. More is welcome, less is not welcome. Now, do you want me to read the definition of current asset? Because you have already learnt it so many times. Once again, little fast. You have done it. An asset is classified as current. Normally people think current asset means it is realizable within 12 months. That is only one of the 4 definitions of current asset. There are 4 definitions, and if you fulfill any of the 4, then it is a current asset. It is expected to be realized or sold or consumed. Realized word will be used basically for receivables, sold for finished goods, and consumed for raw material stores, WIP, in the normal operating cycle of the entity. In the normal operating cycle of the entity. Now the question will come, what is a normal operating cycle? Which also is printed somewhere below. Means time required to convert your cash into raw material into WIP into FG into debtors, and then again debtors into cash. Now the problem is that in some industry operating cycle can be more than 12 months. Like for example wine manufacturing industry, where the operating cycle may be 3 years, 4 years. So in their case, if the debtors are expected to realize within 3 years, then also it is current. If the inventory is expected to be sold within 3 to 4 years, then also it is treated as current. Or say construction industry, where it takes many years to first construct the flats and then you sell them. Then it is held primarily for the purpose of trading. Any asset which is held for the purpose of trading. Now here we don't look at the time period. You can sell any time. Then it will become an inventory. Then it will become a current asset. For example, inventories. Once you have kept the inventory in your office, in your showroom, and you have written for sale, it is a current. Now it may be sold after 15 months also. And this is what normally we mean by current asset. It is expected to be realized within 12 months. Underline, after the end of the reporting period. 12 months from which date? After the end of the reporting period, not 12 months from invoice. Not 12 months from invoice. Is it right? Many students here make a mistake. They think that it is 12 months from the date of invoice. It is 12 months from the end of the reporting period. If it is realizable, then it is a current asset. Example, receivables. And fourth, it is a cash and cash equivalent. Cash and cash equivalent we will discuss in IAS 7. Statement of cash flow. So cash in hand, cash at bank, or any cash equivalent item will be treated as current asset only. Cash equivalent means short-term highly liquid investment. Short-term highly liquid investment which can be converted into cash very quickly without much loss of value. Is it right? However, if there is any restriction on use of that cash and cash equivalent for at least 12 months after the reporting period, then it will be treated as non-current. Example, a bank account of a company is frozen by the government. A person does the default. So what the company or the government does, or the regulation does, regulatory authority, they put a ban on any movement in that bank account. And it is for 2 years now. For 2 years you can't bring or withdraw money. So even though it may be a bank account, even though it looks like a current asset, but there is a restriction on being used that money, then it will become non-current. So this happens when a company go into liquidation, there are frauds in the company, or if it is in some foreign country and the foreign government puts a ban on the remittances. So then it is possible that your bank account may also be a non-current item. Now we'll solve one question and then we'll conclude the today's lecture. Okay, solve without reading the answer. X Limited has identified its operating cycle. Is it there? X Limited has identified its operating cycle as 12 months, comprising of raw material 4 months, plus 1 month production time, plus 3 months finished goods holding period, plus 4 months collection period. Is it matching up to 12 months? Yes. So gross operating cycle is 12 months. And as on the reporting date on 31st March 2015, X Limited, this is our reporting date, carries out age analysis of spare part inventory. So what is the current asset item we have? Spare part inventory. What is the operating cycle period? 12 months. Spare part purchased on 1/7/14, 10 lakh. Spare part purchased on 1/2/14, 5 lakh. Spare part purchased on 1/10/14, 20 lakh. Classify the spare parts into current and non-current. If it is going to be consumed within 12 months of operating cycle, it is current. Or if it is going to be realized within 12 months from the end of the reporting period, then also it is current. Now the problem will arise in the second one. These two you can easily say first and the third one as current because it is still less than 12 months. Yes or no? Since you are holding them. But this you are holding since more than 12 months now. Count the number of months from 1/2/14 to 31st March 15. Around 14 months. Student will be tempted to answer. No, student nahi, 14 months. 14 months, since 14 months you are holding. So student will be tempted to answer it is a non-current. But then if you look at from the balance sheet date, you have to see within from the balance sheet date, can we consume it within 12 months from balance sheet date? If the answer is yes, then this will also be classified as current. Okay. So if you can prove to if the management proves to the auditor that this inventory will be consumed within 12 months from the reporting date, then also it will be classified as current. Okay. Okay. Now let us see. As age, this age is 9 months, this is 14, this is 6. This and the last one clearly gets identified as current. This they have written 5, but there is a note below. What is the note below? Spare part expected to be consumed within 12 months after the reporting date, that is by 31st March 16, will be classified as current asset. So for this small case study, you have to write both the answers. You have to write both the answers. You have to write that it is expected to be consumed within 12 months from the reporting date, then we will classify it as current. However, if it is not expected to be consumed within 12 months from the reporting date, then we will classify it as a non-current asset item. Okay, now we will continue tomorrow.